Cryptocurrency, it promised to be this incredible new, decentralized frontier for finance. But like with any new frontier, you get new outlaws. And in this digital Wild West, the heists are bigger, they're faster, and way more complex. But what if, and this is the key, what if the very technology that allows these crimes to happen also holds the secret to solving them?
Okay, just take a look at this number. So far this year, illicit crypto addresses have raked in at least $40.9 billion. And get this, analysts at Chainalysis say that's a lower bound estimate. As investigators keep uncovering more criminal wallets, this number's only going to go up, probably making this a record year for on-chain crime.
But behind that absolutely staggering number are real people. This isn't just about data on a screen, it's about devastation. We're talking about people losing their homes, their retirement, their entire life savings in the blink of an eye. The stakes here, they could not be higher.
So how does it all really work? Well, in this explainer, we're going to take a journey right into crypto's criminal underworld. We'll bust the whole myth of anonymity, see how investigators follow these digital breadcrumbs, then we'll look at the escalating arms race between the criminals and law enforcement, and finally, we'll ask what's next for on-chain justice.
All right, first up, let's dive into this criminal underworld. You see, in the early days, the appeal was pretty obvious. Criminals thought they'd found a completely untraceable way to move money anywhere in the world, totally outside the normal banking system.
And what's really interesting is that the criminals' currency of choice has dramatically changed. It's not really about Bitcoin anymore. Today, the huge majority of illicit transactions, we're talking over 63%, happen with stablecoins. You know, the ones that are pegged to currencies like the US dollar?
And the whole criminal landscape has gotten incredibly diverse and professional. I mean, this isn't just about hackers anymore. We're seeing everything from these super sophisticated ransomware attacks and darknet markets to crazy investment frauds like rug pulls. That's where developers just vanish with all the investors' money.
But here is the central irony in this whole story. The very thing that made crypto so attractive to criminals in the first place, this idea that it's anonymous, is actually a myth. And it turns out exploiting that myth is the key to catching them.
You see, transactions on the blockchain aren't truly anonymous. They're pseudonymous. Think of it like a famous author writing under a pen name. You might not know their real identity at first, right? But all of their work is publicly connected to that one single pseudonym. And if you find enough clues, you can connect the pen name to the actual person.
Now, this is all possible because of the engine that powers all of crypto. It's called asymmetric cryptography. At its heart, it's a pretty simple system built on pairs of keys, a public key, which you can share with anyone, and a private key, which you have to keep totally secret. Let's make that even simpler with a quick analogy. Just think of your public key as the P.O. box address. Anyone in the world can see it, and they can send crypto to it. But only you, with your secret private key, can actually open that box and get to the funds inside.
And here is the central paradox. Every single transaction between all these public P.O. boxes is recorded on the blockchain, which is basically a permanent, unchangeable public ledger. So it's less like a secret Swiss bank account and way more like a global notebook that anyone can open up and read.
So this permanent evidence trail creates this incredible treasure trove of digital breadcrumbs. The big question for investigators then becomes, how do you follow those breadcrumbs to connect a pseudonymous wallet address to a real-life, honest-to-goodness criminal?
This is where the real digital detective work begins. A wallet address might not have a name attached to it, but its every single move leaves behind a permanent trail for anyone to follow.
So investigators start with these tools called blockchain explorers. These are just publicly available websites that act like a search engine for the blockchain. You can punch in any wallet address and see its entire history, every single transaction in, every transaction out, and its current balance. The evidence isn't just available, it's literally hiding in plain sight.
From there, investigators use a really cool technique called transaction clustering. They have powerful software that sifts through millions and millions of transactions, looking for patterns that can link different wallet addresses to a single criminal entity. And this whole thing is built on a simple but incredibly powerful assumption called the common input ownership heuristic. See, to send crypto, you need the private key. So, if a bunch of different addresses are all used to send funds in one single transaction, it's almost certain they're all controlled by the same person. This is what lets investigators start clustering addresses together, basically building a map of a criminal's entire financial network.
Of course, criminals know this is happening, and they are not just standing still.
This has kicked off a constant technological arms race, with criminals inventing new ways to hide their tracks and investigators, in turn, developing brand new tools to find them.
A major tool that criminals use is something called a coin mixer. They'll send their stolen funds into this mixer, which pools it all together with funds from tons of other users, some legit, some not, and then it spits the money back out to new addresses, all in an attempt to break that chain of evidence. But even the mixers can be beaten. Forensic analysts are fighting back with some pretty sophisticated statistics to unmix the transactions. For example, they can use a method called proceeds in, first out, where they basically assume criminals want to cash out their stolen money as fast as possible. This lets them follow the most likely path the money took, even through all that noise.
And this arms race goes all the way down to the fundamental code itself. This chart, for instance, it compares two different ways of encrypting information. Now, you don't need to know the details, but the key takeaway is simple. There's no single best way to do it. It's always a balancing act between speed, security, and complexity, a trade-off that both the criminals and the investigators are constantly trying to exploit to get an edge.
So what's the end game in this whole battle? I mean, this is a fight that is fundamentally shaping the future of finance, of privacy, and of justice itself in our digital age.
For investigators, the end game is always to follow the money to an off-ramp. This is usually a crypto exchange where the criminal tries to cash out their crypto into traditional money, like dollars or euros. And these exchanges are regulated businesses. They're required to collect Know Your Customer, or KYC info. That means getting a real name, an address, a government ID. And that's it. That's the moment the pseudonym gets linked to a real person.
And this brings us to the fundamental question at the very heart of cryptocurrency itself. The blockchain was built to be radically transparent. Now, criminals saw this as a flaw they could exploit, but law enforcement now sees it as a feature, a permanent public trail of evidence. So is this transparency a bug that destroys privacy, or is it the very feature that could build a more accountable financial system? The answer to that question is going to define the future of money.